Welcome to today's lecture on IAS 20 government grants. IAS 20 tell us when to recognize grant and how to present them so financial statements stay fair and comparable. So in this short video, I will be sharing with you all the definition related to IAS 20, its scope, core rules, disclosure, framework, example, and some common mistake and takeaways. Okay, here we have a definition of IAS 20 government grant. Government grant is government assistance in the form of transfer of resources, cash, or asset to an entity in return for past or future compliance with certain conditions related to entities' operating activities. Okay, what is government assistance? Assistance is any help provided by the government to support businesses. Like tax relief, free training, advisory services, it will be a non-cash assistance. Okay. Here we have a scope. So in a scope, we will discuss what it includes in IAS 20 government grant and what it excludes. So it covers the government grant related to income, government grant related to assets, non-monetary grants. So what it excludes, government assistance that cannot be reasonably valued, grants related to biological asset Act 41 and government grant participation in ownership. Okay, here we have a recognition criteria. Recognize a government grant only when there is a reasonable assurance condition will be met, grant will be received. Disclosure. So for the disclosure, accounting policy used, which type of accounting policy used need to be disclosed, nature and extent of grant, unfulfilled conditions and contingencies. Okay, now we have two type of grants, revenue grant and capital grant. Revenue grant is a grant received other than asset and capital grant is grant relates to acquisition and construction of asset. Okay, now first of all we have revenue grant. In a revenue grant, we have two methods. One is separately income record method and relevant expense net off method. In a separately income record method, we will simply separately record grant as an income in statement of profit and loss section. And in a net off method, we will just net off it with relevant and expense like the 1500 cleaning cost. We net off the grant income and record the 500 amount here in this example. In a capital grant, we also have two methods. One is net off method and the another one is deferred method. In a net off method, we will just deduct the grant amount from the plant, and after getting the value of 8,000, we will record our depreciation on that amount. And after that, we will get the carrying value. Okay, so for the presentation in a statement of financial position, the carrying value of the 6,400 will be recorded and the depreciation of 1,600 will be recorded in statement of profit and loss. So for the deferred method, here we have option and in a deferred method, we will record the plant separately from the grant value and we will get a 2,000 depreciation. Now deducting the 2,000 from 10,000, we will get the 8,000 carrying value. We will record the depreciation expense of 2,000 in statement of profit and loss. And for SOFP, we will record the 8,000 amount. The grant will be recorded as 2,000. Amortization will be charged on it, and we will get over the 1,600 amount. So in this 1,600 amount, we have the current value amount and the non-current value. How the non-current value will be calculated? So we will simply remove the current liability portion, which is 400, and we will get the 1,200 amount. And the grant income will also be recorded in statement of profit and loss, which is 400 amount. Okay, here we have a step-by-step framework for IAS 20 government grants. First of all, we will identify government assistance, check if it qualifies as a government grant, confirm reasonable assurance, measure at fair value, present correctly, asset or income, disclose required information. Okay, now we have a simple example. Government gives 1 lakh to buy machinery and its useful life is 5 years. So the grant will be for 5 years. Treatment is deferred income method. Now, first of all, we need to pass a journal entry and record the grant. We will debit the bank with a 1 lakh amount and credit the deferred grant income with the same value. Now, the grant is for 5 years, right? We will divide the 1 lakh amount by 5, so it becomes 20,000. 20,000 income will be recorded in every year, recognized as an income. Okay, so for that, what entry will be passed? We will debit every year. We will debit the deferred grant income with the amount of 20,000 and record the income with the 20,000. Uh, Here we have a journal entry, other income credit, your grant income, not other income. We need to record it as a grant income credit, and deferred grant income debit. Okay. Okay, let me just give you one another. Okay, here we have a grant repayment concept in revenue grant. XYZ received grant of 3 lakh for 3 years to maintain employee level of 50. So in year 0, the XYZ received grant, and they record it simply by debiting debit cash and credit deferred income with a 3 lakh value. And in the year 1, the criteria met, so they record, and they record the income by simply crediting grant income with the 1 lakh amount and debit deferred income with 1 lakh amount. So year 2, the grant is repayable. Why the grant is repayable? Because the employee level reduced from 50. So now the condition is not fulfilled in year 2. So the grant is became repayable. So in a repayable, we have two cases: full repayment and partial repayment. Full repayment, we will just credit the whole grant amount, 3 lakh, and debit the deferred income, which is not recorded, by 2 lakh, and the income which is already recorded will be debit as an expense. In a partial repayment, the income which is already recorded will not be treated. We'll just credit the not the 2 lakh amount, okay, the 2 lakh deferred income, and debit the 2 lakh deferred income. Okay. Now, lastly, we have some common mistake made in IS 20 government grant, recognizing grant before reasonable assurance, treating tax holidays as government grants, recognizing grant directly in equity, forgetting disclosure requirements, mixing asset-related and income-related grants, and some key takeaways. We have some key takeaways. Not all government assistance is a government grant. Government are grants are recognized only with reasonable assurance. Grants are recognized in profit and loss, not equity. Okay, thank you so much. This is all for today's video.